you can see this on the chart, look at the winter line. This is the interesting one where we really started to see kind of the effects of speculation entering the market. If you look at the dotted lines that are there, and those are lines where after the first few halvings, we decided to try to model how is the price reacting, how is the market reacting to these supply shocks. And what we found was that from the first and the second and even the third halving, the ratio of prices moved towards the ratio of production rates at a ratio of about 1% per day. And that gives these dashed lines. So those dashed lines presume that that's what's always going to happen. You can see the prices did follow the dashed lines pretty closely for the first few years. But last year, with the winter halving, what happened was that long before the halving took place, it was months before the halving took place, the winter price started to go up. And that was because of speculation. People knew that winter was going to become the most expensive token, so they bought it early. And the result of that was that the halving didn't even have to happen for the winter price to increase. But after it did happen, of course, it did continue to help push the price up, and winter did become the most expensive token. But as you can see, what happened is that the winter price went up. It went up too far too early. And as a result, there was a market correction. And this is what happens when prices move too far in one direction too early or at the wrong time. The market corrects because what happens is that it's psychology that's driving the price. But there are two market kind of forces, really, psychology and economics. And what happens is that most of the time, psychology is controlling how the price moves, because the price is in between two bounds. So the price will go up and down because of psychological forces, and it will go up too far because of optimistic psychology until the economics kicks in. And once that happens, there's a market correction. So people realize they're paying too much for this. The market corrects, and then people who've been paying the wrong amount of money realize that they've made a mistake. So you can see the effects of that in the winter price. So it is actually an interesting story what happened with winter. People were too speculative too early. They bought too much of it too early, pushed the price up too high. Then there was a market correction for a while. And then after that, you can see just when the winter price corrected, it's as though people lost hope that the prices were not going to be the same anymore. What happened is that the prices kind of latched into each other and stayed very tightly connected to each other. Maybe I can zoom in on this little period actually here on the chart. Maybe we can see that. What has happened here in this middle part of this chart, you can see there's no clear token that was the most expensive, no clear token that was the cheapest. The prices kind of stayed very close to a ratio of 1-to-1 to each other. It was in December of 2024 that this happened. So this was a strange period because people suddenly decided to trade tokens for other tokens and take the tiniest profits that they could. So people were trading and getting like a 1% increase in the total number of tokens that they own. And the result of that was that the prices didn't move away from each other very much. So that showed up on the chart as these prices all being kind of tied to each other. And what was happening psychologically was that people were thinking, oh, there's a chance for a 1% profit, I'll take it right now. In retrospect, that was a foolish thing for them to do, because what happened was that they were trading winter, which was being produced at the slowest rate, for spring, which was being produced at the fastest rate, and they were trading them at an approximately 1-to-1 rate. And you can't do that. Like, just the economics says that you can do that for a little period of time, but what will happen is you will run out of winter. If winter is being produced slowly and spring is being produced quickly, and you're trading them at a 1-to-1 rate, you're going to run out of whichever one is being produced at the slowest rate. And that's what happened. Maybe we can go back to the original chart and see what happened after that. So what happened after that was, people did that for about a month, maybe in December of 2024, and then people ran out of winter. And you can see that after that, the winter price stopped being kind of pegged to the other prices and broke away again, and the winter became the most expensive token for the next, up until today. Winter's still the most expensive token, and that's because it's been produced at this lowest rate until now. But what people can't do now is trade Winter for spring right now. And the reason they can't do that is because they already just traded all their Winter for spring. Either in December of 2024 when they were trading it at a terrible rate, or maybe if they were wiser, then they kept their Winter and then they traded it for spring over the last 6 months or something like that, because that would have been the time when you could get a better rate for it. And the people who waited for a higher exchange rate, they did better, they profited more, they got more tokens in total than the people who took the tiniest profits that they could.